I began trading the financial markets over 10 years ago, and I looked at all the software that was out there, and one of the things that I found to be problematic was the fact that there were two types of systems. Well, let me go into that in 1 second. Basically, this is in some instances a very unique business. Many vendors ask you to buy software or buy trading techniques that you can't even see until after you buy them. And the most important thing is they come with back-tested strategies and entries in which they haven't quantified mathematically the sensitivity, specificity, and positive predictive value of the trading entry. And many of the systems that they proffer are just plain broken. And I just want to show you one really quickly. There are systems out there that are based on oscillator entries with Renko bars. And in order to for the oscillator to work mathematically, it's got to be able to compare the high and low of the bar with the close of the bar. And if you look at Renko bars, now here's a range bar, and you can see that you can see the high of the bar, the low of the bar, and you can see the close of the bar, and also the open. So the percent K that's traced out is an accurate percent K, and that's the important line when you look at an oscillator, or in this particular case, stochastic, which is just one of many oscillators. But when you look at Renko bars, there's a high and the low, but there is no opener and there is no close. So the percent K line that's traced out doesn't work. It is simply profiling the contour of the Renko bars. It's not really giving you any overbought, oversold readings. So you really have to do a little bit of your own due diligence and understand exactly what the software that you're looking at or purchasing is trying to do. And in order to do that, I always recommend a book called Trading for a Living by Alexander Elder. You can get it on Amazon for about $10, and he really was a pioneer in describing not only mathematically but in a concise paragraph exactly how different indicators work and how they're and what kind of information they provide you. And he's also the person who invented the triple screen method, which is really a method that we've adopted here. Now, they're basically two basic underlying strategies that software developers take when developing a program to define market direction. There are those in the camp that believe that price action alone provides you with enough information to trigger a buy or sell entry that has the positive predictive value high enough to make you a profitable trader. And then there's the camp of people that use indicator analysis. And they believe that there's some unique composition or confluence of indicator signals that, again, when they mature, provide you with a buy or sell recommendation that's going to have the positive predictive value high enough, again, to make you profitable. And when I talk about predictive value, I talk about the sensitivity and specificity of the trade, because positive predictive value is the sensitivity of the trade over the specificity of the trade. And I'll just talk about that a little more in a minute. And a further subdivision are those that trade one time frame and those that use multiple higher time frames to confirm the validity of their entry. So at Rightline, we sort of reject each unique hypothesis, and we also agree with them and believe that each of them provides information that's really essential to providing a trade with the sensitivity and specificity that we need. We don't believe that price action alone provides a trader with enough information to take trades that have a very high positive predictive value, i.e. enough to make you a successful trader. Neither does any confluence of indicator signals. I mean, no single indicator-based system that will that tries to get you into a trade based on some confluence of indicator signals without taking into account market structure is strong enough to make you a profitable trader. And I know you've seen a lot of these systems, and when they're evaluated in retrospect, they all look great. But when you analyze them prospectively, they do not produce. Now, if either of the above were true, some confluence of indicator signals got you into a trade with a very high predictive value, then that signal could be robot traded and you could make millions of dollars in profit. Same thing with price action. If some unique price action setup, when it formed, provided you with enough information to get you into a trade with a very high predictive value, it could be assessed analytically. It could get you in, and again, it could be robot traded. The problem is that there's always a 10% discretionary component to the trades, and we'll take a look at that. So the goal of right line trading is to combine all of that information. It's to combine market structure analysis, which has got to be done. It's an integral part of trading, with indicator analysis. And it has the indicators make assessments from multiple higher time frames, and we assess market structure / price action from multiple higher time frames. So it does its own fractal analysis. So you don't have to look at multiple higher time frames in order to trade, say, a 377 tick or a 1 minute or a 3 minute. The indicators analyze data from multiple higher time frames and do all that heavy lifting for you. And we combine that into a simple trading platform that's been optimized mathematically to provide you with remarkably accurate trading entries. And I go to a lot of webinars and I ask the presenters, what's the sensitivity, what's the specificity, and what's the positive predictive value of your trading entries? And so far I've yet to ever get an answer from anybody. And the fact is, if you don't look at the software as simply a multivariable equation that needs to be optimized via computer analysis with each of the parameters that we need, say market structure, indicator analysis, fractal analysis, being looked at as independent variables, where ultimately the dependent variable is the trading entry. And those aren't optimized such that you know the sensitivity and specificity of your trading entries, and you really don't know anything about your trading algorithm. And that's critical in order to proffer to you the system as a profitable trading system. Now, we have a very strict methodology, and what we do at Right Line is we look to trade with specificity and not sensitivity. If you trade with sensitivity, i.e., you look for all of the true positives, you're going to pull in a lot of false positives. What we look to do in trading with specificity is we want to look for all the true negatives. We don't want to get into losers. And I'm sorry, we look for false positives, and we look for the true negatives. When a trade threatens to break out but doesn't break out, we don't want to be in that trade. So that would be a true negative trade. So our methodology is really precise. And as part of that methodology, we don't call tops and we don't call bottoms. I mean, it's my personal belief that that's not possible to do based on market structure and indicator algorithm analysis. It's impossible to do with any degree of predictive value, again, that can make you profitable. We don't trade reversals. We do not counter trend trade. And we do not try to predict breakouts. I don't think any system can tell you that the market is going to continue on. We only are trend traders. And you'll see that we look for very specific places to get into a trade, get into a trend trade early, and ride the trend. And it's my belief that institutional traders set the trend, and we want to be on board with them. It's our goal to define a trend early and get on board that trend fast. So let's take a look at this. This is a crude 8-range chart for March. You can see right here, this is an engulfing candle calling a bottom at a swing pivot low. This will be a nice place to take a long based on market structure alone. But then if you start looking at all of the other price action market structure, I don't find that there's enough information here to continually get me into winning trades. And I've read a lot of books on candlestick formations. I understand all of them. And we take price action extremely seriously. And I believe it's about 75 to 80% of the information that goes into a trade to make it successful. But I don't believe as a standalone it's sufficient. So what we do is we divide the chart into a buy-sell region. When price is above the 50, and this is simply a 50-period simple moving average. When it's up, it's green. When it's down, it's red. When price action is above, we believe the bulls are in control. We only go long. When price is below, we believe the bears are in control. We only sell short. If we look to go long below the 50, we consider that a counter trend trade. We don't counter ever, and we do not ever counter trend trade. Then we've added what's called a modified 15. This is a 15-period moving average. It's a proprietary line, and we look for the 50 and the 15 to be down. When the modified 15, as we call it, is yellow, it defines chop, and we don't trade. So we look to get into trade setups where either the 50 and the 15 are down, or the 50 and the 15 are both green or both red. And then we add pivots. Pivots, I believe, are very important information, and we have a very unique pivot indicator. It's broken by a 2/3 candle close below or above, and we do not trade, almost never trade into unbroken pivots. And then by looking at our more multivariable equation, we determined that the distance the open of the candle is from support or resistance is a very, very important parameter, which we've defined. And we have an indicator that tells you how far the candle open is, in this case from support, this is the modified 15. We want the candle open to be no more than 4 ticks off the 15 if you're trading an 8 range. If you're trading a 5 range, it's no more than 3 ticks. A 3 range, it's no more than 2 ticks. And we have all these parameters defined, and we tell them to you. And then the 3 indicators that we believe are extremely important is order flow, stochastic direction, and momentum direction. And momentum is simply a MACD system. But we want to analyze that for multiple time frames. We just don't want to look at order flow, stochastic, and momentum from the time frame of the trading chart. We want to look at it from multiple higher time frames as well. So what I did was develop what's called the 3-line indicator. Now it looks really complicated, but actually it's really, really simple, and it projects all its information directly onto the price bars. And when we move to the trading platform, you'll see how easy it is to use. But line 1 is order flow. When order flow is down on all time frames, the line is red. When it's down on higher time frames but up on shorter, it's orange. Remember, higher time frames rule. When it's up on all time frames, it's green. When it's up on longer time frames, down on shorter time frames, it's blue. Okay to take a long trade. And that's the same for order flow, stochastic, and momentum. And the 3-line analyzes all 3 of these parameters on multiple time frames. Now let's take a look at an actual trade. What we have here is, actually let me go to the next slide. You can see that the candle's outlined in blue. And this outline forms intrabar. All the indicators do their calculations intrabar. Now remember, we want to be a trend trader. So we want to trade when the 50 and the 15 are both green. In this particular case, they are. The candle's outlined in blue, which tells you that order flow, stochastic, and momentum from the 3 line are green. And you know this intra-bar, so we would set our buy stop limit order 1 tick above the close of the candle, and up we would go. Our order is sitting there waiting because we know intra-bar, we've got our blue outline, we know where the candle's going to close, and we know that it's going to break the 50, and we're trading with the 15 and the 50. And really, here's the same trade again. Whoops. The reason it is because I'm hitting the wrong color. Now, here's the same trade to the downside. We break the 50 to the downside. We have the 15 and the 50 down. The candles outlined in yellow, which means order flow, stochastic, and momentum are with you to the downside. And your sell order is a sell stop limit, 1 tick below the close of the candle. The entry is precise, and we know that the predictive value of these trades are 85% or greater. We know the sensitivity, we know the specificity, and we know the positive predictive value of the trade. These are very, very successful trades. And here's a break of the 15. Again, 50's down, 15's down. We break the modified 15 with order flow, stochastic, and momentum with us. Down we go. Same thing again. I mean, you can see it becomes redundant. We're looking for a break of the 50. We can't take a long here because the 50 is red. We got to wait for it to roll. We got the 15 and the 50 have to be green. Candles outlined in blue. Order flow, stochastic, and momentum are with it, and up we go. Now, here's where the software analyzes market structure. The A and the B and the C were not placed on this slide by me. They were placed on it by the software. An A is defined by any candle of the same color, 2 red candles in a row, 2 green candles in a row. They define a trend, a downtrend or an uptrend, and you see an A print. And then we let the downtrend continue. Now we can't take a short on this break of the 50 because the 50 is up, and we don't have the 15 and the 50 corresponding in color. So we let the market break. Now the B candle, I choose to color in, make it magenta. But what this is it consists of buyers coming in, pushing the market up. They're calling a bottom, they're counter trend trading, they're calling a reversal. And this is what we look to do. We look to capitalize, actually, and kind of punish the people who do this, the traders that do this. Because then we get a flashing C. And that tells, when the B prints, we get the only audible alert we have in the system. And it tells us that we have the potential for a C candle to engulf the B. We know where the engulfment is going to take place because we have an indicator that tells us where the candle is going to close to the downside and to the upside. We simply put our sell stop limit order in 1 tick below the close of the candle, and if it does engulf and the trade does mature, we're in 1 tick below the close and down we go. Now there are 2 forces that propel this trade to the downside. One is the addition of new sellers, and the other is the fact that we get to run over all the buyers in the B candle. And that is a really powerful force. And as this candle hits its target, the traders in the B candle begin to get stopped out. And when they get stopped out, they've purchased positions. They have to sell them to close. And that pushes this candle down. This C entry, the C candle entry, with a red 50 and a red 15 to the short side, so that we're trend trading, is the most powerful single entry that we have. Now, the predictive value of this entry, the C, is close to 90%. Here is the same trade again. The market comes down, a B prints audible alert, the C comes, you can see the C is outlined, so that you're not only trading a C, but you also have order flow, stochastic, and momentum with you. Your sell order is one tick below the close of the candle. Down you go, running over all these traders in B. And these are all the traders trying to call the bottom, trying to counter trend trade, all getting run over. And traders that do this, for the most part, get run over a lot. Same setup. We come down, retrace back to the modified 15. That's what we're looking for. Remember, we only want to be 4 ticks off this modified 15. This C is really tight to the 15. We're right off resistance to the upside. The C engulfs to the downside. We're in 1 tick below the close, and down we go. Now, we also have other entries, but really the strategy is the same. We look for the break of the 50 and the 15, the retracement, and then the confirmation trade back into the trend. This is a momentum signal. This analyzes momentum for multiple higher time frames. You can see that the candle doesn't engulf the previous red candle, but it does confirm the upside move. Order flow, stochastic, and momentum are with you to the upside. You're sitting right on support. Your entry is 1 tick above the close of the candle, and up you go. If you get stopped out on this retracement, you're in again, up you go again. Here's another momentum entry, again with order flow, stochastic, and momentum with us. We don't even have to look at the 3 line because the data we need is projected right onto the price bars. Down we go, running these traders over. We also have a power entry. It uses another, it's really a little bit of different logic, but again, it's looking to do the same thing. We only trend trade. The 15 and the 50 have to be up. In this case, the trigger, we don't have order flow and momentum with us, but it comes to us on the next candle. But we're taking the retracement right back to support and moving the trade back right into the trend. We're in 1 tick above the close of the candle, and up we go. These are the power entries to the downside. Again, now the three line indicator is not on this chart, but we get the retracement back to resistance to the upside, get the power entry signal down. We run over all these buyers. We're counter trend trading, calling a bottom, and down we go. If the retracement stops us out here, we have no system generated signal to take it short. We just let it fall. And then we have this additional retracement, power entry, and down we go again. Here's a strategy entry. Again, slightly different logic for getting you into the trade, but it's all identical logic. It's based on a very specific set of rules. We go up. We retrace back to the modified 15. We don't call the breakout. We wait for the retracement, and up we go. We run over all the people, all the traders who are sitting in this red candle. We're trying to counter trend trade. And we know that the trend is up because the 15 and the 50 are both up. And you can get multiple signals. Here is a C candle and a strategy entry and a momentum signal, and up you go. Running over all the people in the B candle both times. Strategy entry and a C engulfing candle, running over all those traders again, up we go again. And here's a move to the downside, same thing. Order flow, stochastic, momentum with us, break of the modified 15, 15 and 50 are red to the downside. We're in 1 tick below the close, and down we go. Now, sometimes we have to wait a long time for these setups to occur, for the 50 and the 15 to come into sync. But it takes a lot of patience, and in the trading room, sometimes we'll sit for 45 minutes or an hour. But we have a lot of faith in the signals, and when they come, we know that we have a very, very high probability of getting at least the first target on our trade. Now, we have one other parameter, and that is we have found that the stochastic does not increase the predictive value of our trade. So what we defined is the MA diff, and I'm going to show you that directly on the trading chart. So I'm going to move over now to the platform itself and show you how we trade. Just hold on 1 second. I'm going to reshoot the chart. Okay. Now we're going to come back to the slides in a minute, but why don't we take a look at the ES today, and let's take a look at how we traded it. Now, I want to show you all the parameters on it. Now, we have an MA diff. Now, the ES is traded on a 5 range, and we want the MA diff. What we found was if the candle trades with stochastic or without stochastic, it does not modify in any way the predictive value of the trade. So we don't really care about stochastic. Now, if you do have stochastic with you, the candle's outlined in red. If you have order flow and momentum with you, it's outlined in yellow. Whether it's outlined in yellow or it's outlined in red, the predictive value of the trade is identical. And if an oscillator does not in any way change the predictive value of a trade, and we found that looking at a year of market replay data, then what does really define overbought and oversold? And again, by looking at it as an independent variable, we found that the space between the 50 and the 15 does, and we call that the MA diff, and it is calculated right here in the upper left-hand corner. So for each of our trades, as they occur in real time, on the right edge, the MA diff is calculated. Now, the MA diff on this trade was 5 ticks, very small. On a 5 range, we want the MA diff to be 13 ticks or less. So basically what we did was, whoops. We waited for the market to come down. We waited for it to retrace, and you can see that the 50 and the 15 are both red. It's the first time we had the retracement into the 15. We were in 1 tick below, and we got 15 ticks on this trade. Now, background bias is one of the most unique indicators I think it's ever been developed. What it does is it looks at market structure and price action for multiple higher time frames. Nothing on this chart affects the background color. It is created by higher time frame market structure. When we've got a light pink, market structure and price action are telling us via algorithm analysis that our down bias is to the downside, but not strong. When it's dark pink, we have a strong down bias. So we're actually looking at the system, looking at market structure and price action on multiple higher time frames and assessing order flow, stochastic, and momentum for multiple higher time frames all on one trading chart. And so bam, down we go for 15 ticks. That's a 3-target trade for us on the ES. Then I took a bounce off the 50, which is just a little bit of a different trade, and that I closed the trade at +8, and it went 10. Then we had the move up. We had the retracement right back to the modified 15. You can see the candles outlined in blue. Order flow, stochastic, and momentum are with us. The trade went 1.5 points. I closed it at 1 point. We got 4 ticks. So we had +15, +8, which is what we got, and we had +4 this morning in the live trading room. And then if you look here, this would be your next trade. And actually, this really wouldn't be a trade. We don't trade into pivots. So even though it's a winner here too, move up, retracement. Whoops, market's live here. And this would have been a nice winner. It's one we wouldn't have taken simply because of the fact that it's a 2-pointer, was because that this unbroken pivot here would have stopped us from taking the trade. So let's move to a different market. Let's take a look at crude oil. And now you can use this on any market, any time frame. It works on tick, it works on time, it works on Renko. It doesn't make any difference at all. Okay. And we got to wait for everything to come into sync. You see here, we've got the 50 going up and the 15 coming down. There's no trade. The modified 15 is yellow. We don't trade a modified 15. Now you can trade a yellow 50. Took the trade, retracement, and it went 6 ticks. Our first target is 5. Actually, we were done for the day. But if you look as we go further, here's your break, here's your retracement, and here's your trade to the upside for another winner. Now you could have gone long here. Wouldn't have mattered. You would not have gotten stopped out. Both of these would have been really nice winners. They would have given you 20 ticks. And we could just follow the whole day. Now we don't take the trade here because we're really tight to a pivot. And we really respect the pivots. There's your next trade to the downside. We break, we retrace. We've got down bias, light pink. We've got order flow, stochastic, and momentum with us. On a tight trailer, we've got 14 ticks. Same thing happens again here. We retrace. We can take the retracement here. Neither one would stop us out. 15 and 50 are both red. And down we go for another 20 ticks. Always trend trading. And we like to trade with background bias. This background bias tells us one of the things it analyzes, are we trading into support or resistance on multiple higher time frames? And it's always a problem. Let's say we're trading into the 50 on a 13 range or an 18 range, and it's going to bounce off. This tells us that we have no resistance to the downside, and we've got clear sailing. And that's it for the day on crude. And let me just show you quickly. I'll show you gold. If I can find it here. All right, we have nothing here to trade. We don't have the 50 and the 15 corresponding. Right here. And that's 8. There's another one. Up. Retracement. Remember, the C candle is the most powerful, and that's 13. Now we can't take this move to the downside, and we can't trade on a yellow modified 15. But actually, here's a trade. Comes up, breaks to the downside, retraces. There's the power entry short. It comes really close to stopping you out. It just misses. And it might have top ticked you out. I can't really tell, but that's 17. Let me see what the high of this candle is. The high is 43.7, and the high of this is 44.6. That much higher. 44.5. You know what? It just takes you out of the trade by a tick. So this would be a loser. It would be a loser, unfortunately, by 1 tick. And that's gold. So really, I could go on and on with this. I only have 10 more minutes. But now, I don't want you to think that every single trade we take is a winner. And you just saw one loser where where we got stopped out by one tick. But that's the system. It's very simple. We look for the same repetitive patterns to occur over and over again. Those are the trades we wait for, and those are the trades we take. And in the morning, we trade the Russell, we trade the E-mini, and we trade crude. Now, I just want to put the slides up again. And then if you have any questions, I will just scroll through them. Now, I just want you to know that our system is going to censor out a lot of good trades, but a lot of trades that succeed, I should say. But what it does is it filters out over 90% of the losers. And really, trading is not about the number of winners. It's about the number of losers. Now, through September, the cumulative trading, the live trading room net equity on $4,000 would be about $40,000. That's about 1,000% return. On our auto trader, for a while we only traded 3 contracts, then we moved it to 4. It's $20,000 through September. And that's about a 500% return. Now, I haven't updated this, and I apologize, but through not from 9/22 to 9/30, we had 23 trades, and we had 2 losers. And this was the net profit in the trading room. We have $4,080 in 1, 2, 3, 4, 5, 6 in 7 trading days. I'm not cherry picking it. We just trade with a lot of specificity. Now, we do have losing days. We've only had 2 losing weeks in the last year. Now, education is really an important part of trading because 10% of trading is discretionary. So at Rightline, we really provide you with an extensive amount of educational support. We do group mentorship sessions. We do personal mentorship sessions. We really support our software. We never charge for any of this stuff. I mean, we want to make you a profitable, successful day trader with what we offer to you. We never ask you to pay for boot camps. I mean, I guess I feel that a boot camp is asking you to pay additional money because you didn't receive enough information when you made the initial purchase. We never charge again for seminars or lectures. The big thing is we're constantly upgrading our indicator package, and we give these upgrades for free for life. And these are all yours as part of becoming a Rightline member. Now, I didn't show you how our direct entry system works just because of time. Leo, was it possible to set that up really quick? We got 5 minutes. I just want to show you this. It's really a pretty remarkable piece of software, and it's part of our direct entry system. And I just want to show it to you. If you come into the training room and you want to, you know how people are always making late calls, and there's always a problem with. Well, what we do is we take the trades for you, and we enter them into our own Rightline Superdome, which connects to your NinjaTrader Superdome, and I'm going to show you exactly how that works. Okay. Can that be seen, Leo? All right. Now, let's say that I want to take let's say that I want to take a trade right here. We're in the live trading room. I enter it. All right, let me exit. Hold on a second. Let's go to 1167.5. I just wanted to execute. because the market's moving slow. There's the order. I just entered it. Of course, it's running away. Hold on a second. Let me close it. Let me put it in at I'm going to close it. Let me put it in at 6. All right, here we go. All right, you know what? It's just not going to work just because of the time and because the market's moving so slow. But basically, with this Superdome, I can take all the trades for you and manage them completely. I can put in a buy a candle close, a sell a candle close, move the stop to -5, -3. I completely manage the trade from start to finish, if you want me to, on the direct entry system. So we have a lot of people in our trading room that don't do anything. And they allow me to manage the trades from start to finish. So let me just go back to the slides really quickly. And we're soon going to be marketing our Superdome as a NinjaTrader add-on. The special that we have is the Right Line Trading, our software package, along with the video tutorials, plus 2 hours of mentorship time with me. You get 2 months in the live trading room, and we sell you the direct entry software. Normally, it is not offered for sale. So that if you come into the live trading room and you wish I can connect to your NinjaTrader Superdome, I can enter all the trades for you, and I can manage the trades completely. 100% trade management is done by me in the trading room. And the webinar special is $29.99 for that. Now, what we do is we invite everyone to come into the room. You go to www.rightlinetrading.com, and there's a link to sign into our live trading room. You'll also see a link there for our daily net equity in the trading room, our daily net equity for the auto trader. You can email us at info@rightlinetrading.com or call us at 1-855-765-6681. I think if you come into the room on a free trial, you'll be very, very impressed, and I think you will wind up becoming a member of our family. So now I just want to go over and look at the questions and answer as many as I can. Okay, here we go. Okay. No, I know. John, we have to correct that spelling. The YM trades really, really well. The only reason we don't trade the YM or the NASDAQ is because they're too many. Right now we trade 3 markets, the ES, the Russell, and crude, and it's just not possible for me to watch these additional markets. You can get, and you can get the free trial to the room. It can be used to trade the ES, or I'm sorry, the 6E, really, really well on a 5 range. I do trade it live. I just want you to know that, and I show my net equity for my own Superdome very, very often in the room. So somebody mentioned, I mean, being a little cynical. Why make money out of selling it and not trading it? Well, I do trade it, and I trade it live every single day. We only work off the NinjaTrader platform. It works really well on stocks. Like I said, time, tick, it doesn't make any difference. We just choose to trade futures, but it'll work on any financial instrument. We've looked at the bonds, notes, really every market. It trades great on the 6E. We're looking to start a Forex trading room. The dollar pound, dollar yen, and the dollar euro trade really, really well on a 5 range. So really, I mean, you can trade almost any financial instrument you want. So listen, my time is up. It's 3:15. And I really thank everybody for coming into the room and listening to my presentation. Again, we invite everybody to come into the room, the trading room, rightlinetrading.com. You'll see the link for the sign up for the trading room. We give you quite a few days in the room, and watch how we trade, and I think you'll be really impressed.